Hey, there is something very exciting going on right now in the world of real estate. Over the last 10 years, there has been an incredible increase in the attention of the sector. More and more people are taking money out of the stock market and putting it in their own control. But what most investors need right now is a due diligence checklist that they can use before making their final decision. And that is exactly what I created with my ebook, 111 Questions Investors Should Be Asking. You can actually get it right now at cfcmentorshipprogram.com/questions. It's literally a list of 111 questions that I ask before investing in each deal. Again, that's cfcmentorshipprogram.com/questions. Welcome back to the Cashflow Connections Real Estate Podcast. Today, we've got a Monday Minutes, which is going to be a little bit of a treat. We're going to take a look at Chapter 11 of my book, Raising Capital for Real Estate: How to Attract Investors, Establish Credibility, and Fund Deals. Writing this book was one of the coolest, most challenging experiences I've had as an entrepreneur. But once we launched it, it has just been a new world. We have sold thousands of copies literally all over the world, everywhere from New York to Shanghai. And the response has been really, really positive. And I really do appreciate those emails. There's a little Easter egg in the book, and people have sent me a lot of emails about that little Easter egg. So if you haven't read the book yet, make sure to do it and definitely send me that little email Easter egg. You can get a free copy at raisingcapitalforrealestate.com. And there's also great goodies on there. The bonus features are, trust me, they'll make up for the $8 that you can get the book for. It's a free book. You just have to cover the shipping. So go over to raisingcapitalforrealestate.com. We're going to do this in two different segments. In this chapter, I talk about the frequently asked questions, and I go into a lot of detail. So I'm trying to give you as much as possible to answer all these questions, to give you all the tools that you can respond to most of the things people ask when you're in the process of raising capital. And as investors get more and more savvy, there's going to be more and more questions. And so having all these tools in your tool belt is going to help out a lot. Again, you can get your copy at raisingcapitalforrealestate.com. And this is chapter 11 of the book. We're going to do this in two parts. So this is part 1. Chapter 11, Answering Frequently Asked Questions. As you can tell from everything I've focused on so far, my system for closing investor capital is really a knowledge-based close strategy. My goal is to ensure that every investor knows as much about the opportunity as necessary for them to make an educated decision on whether or not it's a good fit. In order to put them in this position, you'll need to have a thorough understanding of many aspects of the investment you're raising capital for. As you go through these due diligence calls, you'll find that many of the same questions will be asked over and over again. In this section, I'll discuss some of the most common questions, along with my corresponding thoughts on the topic. My hope is that sharing my perspective will deepen your understanding of each topic, so you can put the answer into your own words, which is always much more useful than simply providing a scripted response. Why should I invest passively as opposed to just buying a property myself? You may encounter potential investors who aren't familiar with the passive approach to investing, or have already had success in real estate as a sole owner-operator. From their perspective, why should they relinquish control to the operating partner when they can probably handle it all themselves? This is common, especially when dealing with accredited investors, so don't be discouraged. Once they've been exposed to the world of passive investing, they'll eventually see the enormous benefits of the strategy. In fact, many talented active real estate owners have significant passive investments in an effort to further diversify their portfolio. Here are a few things I like to touch on regarding this topic. Number 1. When someone is investing in highly complicated asset classes, such as commercial real estate, a top-tier operator can bring a great value to the opportunity, enough that they should make up for the fact that they're even receiving some of the proceeds of the deal. The more complicated the investment vehicle, the more value an operating partner can bring to the table. In a relatively simple asset class, like single-family residences, there isn't a substantial difference between best-in-class owners and mom-and-pop owners. Therefore, an operator just isn't as valuable. However, in a 200-unit multifamily apartment, which functions much more like an operating business, an operator could provide invaluable systems, processes, relationships, and know-how, justifying their participation in the offering. Because of this, the return profile might actually be similar to what an active investor may achieve on their own, but the passive approach doesn't require the investor's time once the investment has been made. To me, this is the strongest case to be made for passive investing. Number 2, the passive approach allows investors to experience diversification across multiple geographies, tenant types, product types, management styles, operators, and many more aspects of the real estate sector. One can't be an expert in everything. Diversification, however, is critical when building a portfolio. From my perspective, the only way to achieve this goal is to have a portion of your portfolio invested in passive investments that are managed by leading operators in a particular asset class. As a tie-in to number 1 above, even if the potential investor has had success owning and operating real estate in more complicated asset classes, it's very likely that they're either over-allocated to that particular asset class or don't have a significant market advantage because they aren't exclusively focused on it. Number 3, due to the distinction between the class of shares between the general partner, the operating partner, the sponsor, and the limited partner, the passive investors, the sponsor is the only party to incur credit and liability risk. This is a major value add for passive investors because it grants them access to low-cost debt financing through the sponsor's track record without incurring the risk associated with personally guaranteeing a loan. Eliminating these challenges of investing in real estate categorically shifts the total risk profile of the investment without ever significantly deteriorating the returns. Number 4, investing in passive syndications allows investors to rely on highly sophisticated operators who stand to gain millions of dollars if they're able to deliver for their investors. This is in stark contrast to typical active investments, where the property values are limited because the investment capital is typically all coming from one person. High-value commercial properties with the potential of producing millions of dollars worth of gains not only attracts high-caliber people, but also genuinely aligns the interests of the operating partner and the investor. Unfortunately, this often isn't the case in single-family houses, where investors may worry about fraudulent property managers who skew invoices in hopes of skimming a few $100s here or there. I find the points outlined above extremely compelling and have built my entire investment approach around them. If you're interested in hearing me make a further case for passive investing, check out a debate I did on the topic at raisingcapitalforrealestate.com. At the end of the day, despite how persuasive the points outlined above are, some investors may be intrigued by the world of syndications, but are reluctant to give up control. If they seem like the kind of investor that's going to continuously struggle with that, a passive LP investment probably won't be a good fit. If control is their driving factor, just be honest with them. Suggest that they stick to the active investments. Of course, let them know that you'll keep them on your list just in case that preference changes, and they'll always have access to your offerings. Why don't I have many voting rights? As I discussed previously, most passive syndicated investments don't allow investors to maintain many voting rights. Accordingly, the overwhelming majority of a passive investor's due diligence process will be focused on the operating partner, and they'll have very little insight into the other passive investors in the offering. Ultimately, passive investors are relying on the operating partner's expertise. If the passive investors in a deal retain significant voting rights, they're allowing their investment capital to be controlled by other passive investors who they know little about and who are likely not experts when it comes to this particular investment. Here's an extreme example. Let's say there is an offering where the operating partner is raising a total of $2 million. In this scenario, let's assume that one passive investor invests $50,000 and another investor invests the remaining $1.95 million. If the operating agreement grants the passive investors a significant amount of control via voting rights, and their vote is based on proportional investment amount, the $50,000 investor's entire investment is subject to the whims of another passive investor who they know little or nothing about. Furthermore, the general public tends to make the wrong decisions during stressful times. For example, if the market starts to slide, you don't want other passive investors forcing the operating partner to sell. This is just one reason why it's usually best to defer to the operating partner to make tough choices. I know this may seem counterintuitive, but many times it's best to limit the voting rights of passive investors to action items like the removal of the manager or raising additional capital for an unexpected improvement of the property. What happens if I need money during the hold period? Despite all of the warnings you may put in the executive summary, webinar, and live presentation, investors might still have an unfortunate misunderstanding about their ability to buy and sell their interest in a deal. It's critical for investors to understand on the front end that investments in syndications should always be considered illiquid and non-transferable. meaning that any dollars invested shouldn't be needed during the entire duration of the hold period. Just be upfront about this, and it'll alleviate a lot of future headaches. However, it's also important that you have a mechanism in place to help an investor if they have an emergency requiring them to sell their interest. Think about it. Even if financial emergencies only happen 1% of the time, if you plan on having hundreds of investors, you'll likely have a few issues throughout your career. Typically, when an investor needs to sell their shares in a real estate syndication, the most critical component is time. So keep this in mind when you draft your legal documents. One legal provision we include in our operating agreement is that we grant the general partner of the offering a right of first refusal to purchase the shares of an investor who wishes to sell their interest without notifying all of the other investors. This way, the problem can be solved while also limiting the amount of time it takes to actually complete the transfer. If you have a similar clause, it's important to reiterate to the potential investor that this provision doesn't set the expectation that the GP will purchase the shares, it's just the first line of defense for resolving the situation. In our offering documents, if the GP decides not to purchase the shares, the next step is to sell the shares to another investor who is already in the offering, which decreases the amount of administrative duties related to completing a transfer like this. We also clarify upfront that there will be a $1,000 fee for anyone who sells their shares before the investment comes full term. From an administrative standpoint, effectuating one of these transfers is fairly burdensome and requires amending legal documents and other administrative duties that shouldn't and won't be paid for by other investors in the offering. Establish a system for resolving these sorts of issues, then be as transparent as possible to potential investors, and when the situation comes up, as it undoubtedly will, handle the problem as quickly as possible. What are the tax implications of this investment? Anytime you get a question about the tax or legal implications of an investment, it's always best to start and end with a disclaimer that you're not a CPA or an attorney. Also, always advise the interested investor to consult with their financial and legal professionals prior to making a decision about investing. When I first entered the real estate business, I thought people who frequently made this disclaimer were being a bit overcautious. As I learned more about the implications of answering these sorts of questions, I began to understand why it's not just industry standard, it's prudent to do so. Even if you are a financial or legal professional, you still need to make the disclaimer that they need to seek out their own counsel on any legal or tax matters. If and when I'm asked about tax implications, after providing them with a brief disclaimer, I usually outline some of the favorable tax incentives for investing in real estate. Most notably, I mention the benefit of depreciation, which is an income tax deduction. In short, while real estate values generally appreciate, the physical components of the property generally lose value during the hold as a result of wear and tear. The appliances, roof, and electrical all depreciate and will eventually need to be replaced. The Internal Revenue Service, IRS, understands and accounts for this by offering an income deduction for owning depreciating assets. Here's how it works. Let's say you buy a commercial property for $10 million. The tax assessor's estimate of the land value is $3 million, and the building value estimate is $7 million. The land value won't count towards the depreciation calculation, but the building value will be depreciated over 39 years. This would imply that each year there would be a $179,487 loss for tax purposes. $7 million divided by 39 years is $179,487. Please note that this calculation doesn't include any benefits of cost segregation, which can sometimes increase the annual write-off property owners can receive. You can learn more about depreciation by listening to the Cashflow Connections Real Estate Podcast, episode 133, How You Can Save Money Through Cost Segregation. Just remember that depreciation is considered a phantom expense. Investors aren't actually writing a check for the loss they're incurring. When someone invests in one of our offerings, they invest in an LLC that holds directly or through another entity interest in a property or properties. Essentially, we pass the benefits of owning the property, including depreciation, through the LLC to the investor. In most real estate deals, depreciation and other tax write-offs allow all cash flow during the hold period to be received tax deferred. This means that regardless of the amount of gross dollars received from the cash flow during the hold, the annual taxable gain will usually be net negative or very close to it. Of course, if the property is later sold at a gain, there will be a tax based on long-term capital gains rates, as well as a tax for depreciation recapture for any gains of a sale made from a depreciated asset. For more information about depreciation recapture, I suggest Googling Investopedia depreciation recapture. Sometimes investors have the misconception that if they invest in a multi-property fund, they won't get the tax benefits of owning property. This is not necessarily the case. Most private real estate funds are structured in such a way that investors receive the benefits of depreciation, but from multiple properties instead of just one. Technically speaking, this can vary for a variety of reasons, so make sure you understand the tax implications of your specific investment. At the end of each year, investors will receive a K-1, which is a tax document for investments in partnerships. The K-1 shows the investor their annual loss or gain and will be presented to their CPA to file their taxes accurately. When it comes to explaining the tax situation of a typical syndicated real estate investment, this is a pretty good start. But of course, as mentioned above, always remember to suggest that investor consult with their CPA and attorney prior to making the decision to invest. What happens if I invest through a self-directed retirement account? Since the 1970s, U.S. citizens have had the ability to self-direct their retirement accounts. This allows the account owner full control over the account and gives them freedom to invest in a diverse group of alternative asset classes, such as real estate, in order to pay for their retirement without being forced into stocks and bonds. Unfortunately, due to the pervasive marketing campaigns conducted by large retirement account companies, only a very small percentage of people know that they can invest in alternative investments while saving for their retirement. The legal requirements surrounding self-directed retirement are incredibly complex and strict. Thus, every SD IRA is required to be overseen by a custodian that's subject to the government's audits. My preferred SD IRA custodian firm is U230 IRA Services, available at u230ira.com. Generally speaking, having an SD IRA is extremely favorable for investors because the vehicle allows for tax-advantaged real estate investments, therefore drastically increasing the rate at which the account can grow in size. However, there are a few caveats to investing in most real estate deals within a self-directed IRA, the most important of which is the unrelated business income tax, UBIT, more specifically, the unrelated debt financing income, UDFI tax. Since it's common for investors to refer to the UDFI tax as UBIT in these discussions, I'll do so here as well. Regardless of the tax-advantaged status of the self-directed IRA, there's a tax on the percentage of the opportunities gains that are attributed to debt financing. Real estate is typically purchased with debt, so it's common that UBIT will play a role in most self-directed IRA investments. For example, if your SD IRA invests in a property that's acquired via 70% debt financing, 70% of the gains will be taxed regardless of the tax-advantaged status of the SD IRA. But that might sound much worse than it actually is. Remember our conversation about depreciation? Typically, the depreciation expense discussed earlier in this book is not allowed when investing through an SD IRA, but depreciation and other operating expense deductions are allowed to be received when using debt financing on a purchase. This is a way of counterbalancing the issues related to UBIT. Usually, this results in no taxable income during the hold period, with UBIT being only due when the property is sold and the gains are actually realized. Even then, a self-directed IRA is only required to file a tax return and pay UBIT if there's more than $1,000 of unrelated business taxable income earned by the self-directed IRA across all of its investments. This is because the IRS grants all self-directed IRA investors a $1,000 deduction as it relates to this matter. The self-directed IRA's unrelated business taxable income is taxed at trust income rates, which are the following for 2019 at the federal level. And since you're listening to this on audiobook, I'll just give you a quick summary of the chart. So from $0 to $2,600, the tax rate is 10%. From $2,600 to $9,300, the tax rate is 24%. From $9,300 to $12,750, the tax rate is 35%. And from $12,750 all the way up to infinite is 37%. So let's say you invested $50,000 via your self-directed IRA and received $50,000 of taxable gains net of your depreciation and expense deductions. If you use debt financing to finance 70% of your purchase, then 70% of these gains, above the $1,000 deduction, would be subject to UBIT. So here's the math on that. $50,000 of gains times 70% is $35,000. These are the gains attributed to debt financing. minus $1,000, which is the $1,000 deduction, equals $34,000 of income to be taxed at the trust income tax rates above. When you apply this $34,000 to the chart above, you get a total of about $10,088 of total tax due. This would result in you receiving $39,912 in gains from the sale net of UBIT instead of the original $50,000 amount before UBIT was factored in. You can use this math on a financial calculator to accurately estimate how your specific investment will perform, but let's say you incur this $50,000 gain and subsequent $10,088 tax over a 10-year period. You're likely talking about the difference between going from a 12% IRR pre-UBIT to an 11% IRR after UBIT, or something similarly negligible. If you're interested in seeing how big of an impact UBIT will make on your investment, input these specific cash flow assumptions into Excel and run your own IRR calculations. But my guess is that the difference is going to be in the 1 to 2% IRR range. Please note that these are all hypothetical examples and just a general overview of the topic. They are not to be construed as tax advice at all. And of course, I recommend that you consult with your CPA before making any investment decisions. Looking at this from a net-net perspective, it's still possible to achieve highly favorable risk-adjusted returns even after UBIT is accounted for. In fact, my personal self-directed IRA is invested in investments that are structured exactly like the example above because the net result is extremely compelling to me. In short, UBIT will impact most real estate investments made through self-directed IRAs because the majority use debt financing. But this shouldn't deter people from considering investing in syndicated leveraged real estate investments within their self-directed IRA. There's no need to dive right into all these details if an investor simply asks about self-directed retirement. But I wanted to provide you with enough context so that you can answer any follow-up questions that they may ask. All right, that does it for part 1 of answering frequently asked questions from investors. Remember, you can get your copy of Raising Capital for Real Estate at raisingcapitalforrealestate.com. In fact, when you go there, you can also purchase the audiobook along with all the bonus features. And believe me, that is one of the best ways to spend $30 that I have ever heard of. So head over to raisingcapitalforrealestate.com and grab the full book and the audiobook as well. All right, hope you enjoyed it.